Hello and welcome.
What if I told you that the most common piece of investment advice you've ever heard is, well, maybe not quite right? You know the one, find undervalued stocks. Buy low, sell high. It's the first thing everyone learns. But what if chasing that idea is actually a trap, especially if you're just starting out? What if there's a smarter, more intuitive way to look at the entire stock market? Welcome to another video on investment basics. In this deep dive, we're going to be exploring the fascinating research and perspective of Mr. Majid Butt. He's an accountant, a software programmer, and a dedicated investment researcher. And he has a way of challenging these big common ideas and offering a totally fresh way of thinking. And hey, you're definitely going to want to stick around for this one because at the very end, we're going to boil all of this down into 6 practical, clear-as-day investment principles that you can take with you and start using right away. All right, let's jump in. Here's what we've got on tap. First, we're going to tear down that undervalued stock myth. Then, we'll introduce a new way to look at things, the story of the stock. We'll get into what makes a good story, what a growth kicker is, and we'll even ask if real bargains actually exist. And then we'll wrap it all up with those 6 principles I just mentioned. Okay, so let's get right into it. The undervalued stock myth. We've all heard it a million times, right? People on TV, financial gurus, they're all talking about finding these hidden gems, these undervalued stocks. But what if that whole chase is just a big distraction? Wow, let that one sink in for a second. To say you found an undervalued stock is basically saying that you, one person, knows something that the entire rest of the market has missed. You're saying you're smarter than the millions of other investors, the armies of professional analysts with their supercomputers, and the trillions of dollars all looking at the exact same information. It's a pretty arrogant claim when you think about it that way. And here's the logic behind why that idea is so shaky. First, think about the competition. It is fierce. You have endless streams of money and professionals digging through the same reports you are. Second, we live in the age of instant information. There are no secrets. All the news, all the numbers, it's out there for everyone immediately. So what you have to realize is that a stock's current price isn't just some random number. It's the market's collective opinion, quantified based on everything that is known right now. If a stock was truly a risk-free bargain, that opportunity would vanish in the blink of an eye. So here it is. This is the big reveal. The term undervalued is really just code. When you hear someone say, this stock is undervalued, what they're actually saying is something very different. They're saying, I have a theory. I believe this company's future is going to be better than what people currently think. And I'm betting that eventually everyone else is going to see what I see. See the difference? It's not a fact about today, it's a bet on tomorrow. Okay, so if chasing this idea of undervaluation is the wrong game, what should we be doing instead? It's all about a change in perspective. It's about shifting from looking at a static number to understanding a dynamic narrative. And this brings us to the core idea of this whole video, the story of the stock. Every single time you buy a stock, whether you realize it or not, you are buying into a story. It's an implicit bet on what's going to happen next for that company. It's a story about its future successes, its potential failures, and its journey. The price of a stock doesn't go up because it was undervalued. It goes up because its story started to come true. The best way to think about this is to compare it to buying a house. You wouldn't just look at the price per square foot and say, yep, it's undervalued, I'll take it. Of course not. You look at everything. You check out the neighborhood, the foundation, the school district, the leaky faucet in the bathroom. You add up all the good things and all the bad things. You try to picture yourself living there for years. And at the end of the day, after all the logic and numbers, the decision comes down to a feeling about the whole package. It's about whether the story of that house feels right for you. Now, obviously, some stories are better than others. You can't just pick any old tale. A good, believable investment story needs a solid foundation. And for a company, that foundation is its core business. So what does a solid foundation look like? 3 things. First, repeating sales. You want a business where customers have to keep coming back, month after month, year after year. Think about your power bill or your grocery bill. Second, you want a stable marketplace. You're looking for a proven, predictable business, not some flash-in-the-pan trend. And third, you want to look for necessities and addictions. These are the things people either can't live without, like food and electricity, or won't live without, like their internet connection or their favorite beer. Companies that sell these things have an incredibly strong and reliable flow of cash, and that's the bedrock of a great story. But a solid foundation is just the start. The best stories have a little something extra. They have a plot twist, an exciting new chapter that drives the narrative forward. In investing, we call this the growth kicker. So what is a growth kicker? It's any special ingredient that has the potential to make a company way better in the future than it is right now. It's the catalyst. This can be anything from the company expanding and opening new stores, or maybe it's a big restructuring to become more efficient. It could be that they're buying up smaller competitors, or maybe they're buying back their own shares, or sometimes they're just in the perfect industry at the perfect time, riding a huge economic trend, what we call a tailwind. Now, speaking of share buybacks, here's a really cool, tangible number for you. Studies have shown that there seems to be a magic threshold around 5%. Companies that buy back at least 5% of their own stock in a given year have a strong tendency to do better than companies that don't. Why? Because it's a huge signal of confidence from the management team. They're basically saying, we think our own stock is the best investment out there, and they're putting their money where their mouth is.
To understand that last growth kicker, riding a tailwind, this classic line from the movie The Graduate is just perfect. The advice was weird, but the idea was simple. Get into an industry that is destined to grow no matter what. The whole industry is a rising tide that lifts all the boats. Think about a company that supplies parts for electric vehicles right now, or a business that builds data centers in our hyper-connected world. They don't have to be perfect, they just have to be in the right place, because they've got the wind at their back.
Now, I know what you might be thinking. Okay, this story idea makes sense, but are there ever true no-brainer bargains out there? And that is a fantastic question. The short answer is yes, but they are incredibly rare, and they happen for reasons you might not expect. And here's the secret. These rare bargains aren't created because the market made a math error. They're created by pure, raw human emotion. Usually, it's mass panic. The classic example is the 3 Mile Island accident back in 1979. The fear was so intense that investors dumped the utility company's stock, crushing it to almost zero. But the panic was an overreaction. The company still had plenty of other perfectly good assets. For the brave few who bought in when everyone else was selling, that stock became one of the best investments of the next decade. These opportunities are born from hysteria, not from a simple miscalculation. All right, we've covered a lot of ground. So just as I promised at the beginning, let's bring this all together. We're going to wrap everything up into 6 simple, powerful principles you can take with you. Okay, principle number 1. Those who assert undervaluation are either arrogant or uncomprehending. This is your reminder to stay humble. Respect the market. Your job isn't to find a $20 bill lying on the ground that somehow nobody else noticed. Your job is to think differently. Principle number 2. Information is everywhere. How could a stock be undervalued? This is the why behind the first principle. In today's world, you don't have a secret information advantage. Your edge can't come from what you know. It has to come from how you think, your judgment, your patience, and your ability to understand a story better than others. And that leads us to principle number 3. The idea of value is really an idea of narrative, of imagining what will happen in the future, in a story. This right here is the big mind shift. Stop hunting for a number on a spreadsheet called value. Instead, become a critic of stories. Your job is to analyze the plot, the characters, and the credibility of a company's future. Principle number 4 is your practical checklist. A good, compelling story of the stock should include these 4 elements. First, that solid foundation of reliable, repeating sales. Second, some kind of growth kicker to give it that future pop. Third, proof that management actually cares about you, the shareholder, which you can see in things like dividends or share buybacks. And fourth, a helpful economic environment, that tailwind pushing it forward. Next up, principle 5. Bargains may sometimes appear under special circumstances, but in general, there are only stories with one degree or another of credibility. This is all about focusing your energy. Don't waste your time on a wild goose chase for mythical bargains. Spend your time getting really good at telling the difference between a believable story and a work of fiction. And finally, principle number 6. The normal story is that the company has well-defined long-term prospects, including the high probability of dividend increases, which will eventually boost the value of the stock. This is so important. You don't need to find some crazy, world-changing story. In fact, some of the most profitable investments come from beautifully boring stories of steady, predictable companies that just keep chugging along, slowly increasing their dividends year after year. That simple, reliable story can be incredibly powerful for your portfolio over the long run. So, let's leave you with a final question to think about. Now that you have this new lens, this new set of tools, take a fresh look at the stocks you might own or any you're thinking about buying. And instead of asking, is this stock undervalued, ask yourself a much better, much more powerful question. What is its story? And do I believe it?